Let's quickly move on to our next guest of the show to talk more about markets and what lies ahead. Joining me is Feroze Azeez, Deputy CEO of Anand Rathi Wealth. Feroze, good afternoon. So good to have you with us. And today the markets, once again, we can see some positive momentum. And overall, since the war started, we saw about 10 to 11% drop on the headline index. So just when people were hoping that the earnings downgrades would bottom, India-US would have soon a structured trade deal, we have another headwind upon us. But today we can say that a bit of a panic has eased. How would you summarize and what are your thoughts? First take on the market at the current moment.
Yes, if you look at the markets, of course, from 25,200, we've come down by about 9-odd%. We had gone down by 9-odd%. We've come back about 2.5-3% from the yesterday's lows, which were below 23,000. I was on a couple of channels back then, saying that the markets had bottomed out. If you look at the kind of short build-up in index futures of FII, if you look at the kind of purchase which was there of domestic the previous day, so it was reasonably clear that 5-7% more fall is what you could have expected, but on the contrary, markets have bounced back. So what has been seen is, if you look at the last 12 wars in this century, most often than not, when the war is over, markets end above the level which they started falling from. For this war, it was 25,200. So once the war settles, in 11 out of the 12 past cases, markets actually ended above the level they started falling from. Will that be the case again? In my judgment, yes. Second, if the war runs far too long, markets tend to forget that news. Of course, crude oil price will not let you forget it as easy. But Ukraine and Russia war, which is the most popular recent war, Nifty went down from 18,500 down to almost about in February 2022. It went down to almost 15,400. That was a 20% drop. But the war still continues, but the market moved on. So that's what will happen if it goes beyond 5-7 weeks. So I personally think these have been great buying opportunities. If you look back, all the instances where things like this happen, where short-term guys give away their stock at discounts, are buying opportunities, especially given the fact that the market has been in a 1.5-year time correction, almost 8% price correction, earnings above by 19% in Nifty from September 24. So good time to accumulate for a 3-4 year periods is what I would summarize. This bounce back gives you some reassurance that the extreme volatility seems to have tapered to moderate volatility.
Okay, got it. But does the valuation give you a comfort at this current point of time? Because, the FIIs have seen net outflows so far this month itself. Despite February being a good month, once again, we are seeing that FIIs have been deterrent for Indian markets. So at the current price point, would you say that Nifty has been trading at comfortable valuations given the kind of correction we have seen so far?
Yes, absolutely. If you look at today, we are looking at almost about 1,170 rupees on Nifty earnings. Now that if divided by 23,000 divided by that kind of earnings, you're almost close to 20 PE. And if you look at forward PE, you have reasonable confidence that Nifty is quoting at almost about 6-7% lower than the intrinsic value, which we end up calculating always. So I would say that it is fair value. Now, if you look at small cap as well, small cap has also gone through some degree of correction. And of course, people tell you that small cap earnings didn't turn up, but they did. NSE small cap 250 had 63 changes. People calculate earnings growth without even nullifying these 63 changes. Like when you do that, last year also in FY25, where everybody had this narrative that small cap ki earnings nahi aayi, that year actually NSE's website computation will show you -9, but the actual number is +18 because 63 companies had changed. So you have to keep the constituents constant. So coming back to whether there's valuation comfort, the answer is a big yes to my mind. I personally think that the earnings forecast of this year's growth, FY26, is to be 3-4% only on Nifty, unfortunately. But small caps will grow 10% this year. Last year, they grew about 16-17%, if not 18-19%. So valuation comfort, I would say, if not in deep green, at least in green.
Okay, got it. But Feroze, can we say that the markets have already reached a bottom pricing in the worst case scenario when it comes of the geopolitical tension and of course the rising crude prices and the logistical bottlenecks that we have seen through the Strait of Hormuz?
I don't think bottoming. See, when somebody has a mood to sell, he can create a new bottom. You don't need some the entire country to sell to create new bottoms. If a FII with almost about 5,000 crores, which is not too much, can once decides to sell it in a single day, because buyers stagger money, sellers don't stagger, especially FIIs don't stagger their exits. So bottoms could be whatever, but will the bottom sustain is the bigger question. So there, beyond 5-7% fall, if there were a fall, if there's a nuclear war, there will be a fall. Now that time is a different story. If that doesn't get escalated to that level, I don't think more than 5-7% falls can sustain beyond giving you reaction time to even mourn for that fall, right? So if market falls 15%, but before the time I start looking at my month-end statement of my money, if the markets are back, then it didn't bother me. So yes, bottom could be further bottoms are possible, but not more than 5-7% falls, which can sustain beyond a few trading sessions, in my judgment.
Okay, got it. But Feroze, in terms of growth and of course the macro risks for the Indian economy, we have seen that several of the global brokerages have downgraded India's growth forecast to about 6.5% from 7.5%. So about 100 to 120 basis point of an impact we are seeing. What is your take in terms of the macro impact on the Indian economy, given that the crude continues to hover above that $100 per barrel?
Yeah, I'm not too worried about the growth, because I said in a few channels that this whole crude thing will also subside, because Strait of Hormuz will be, people will go down there and negotiate and get their ships through like we did. So I'm not too worried whether this $100, $105 will sustain for long periods of time, because it's in no one's interest, no country's interest. That's why you don't see so much support coming in. From different quarters. Not that I'm an expert on geopolitics, but if you look at the GDP growth for the last 10 years, the average has been 7.1. This year, we're going to have 7.7. Inflation average is 4.8. This time, we have 1.8 as our inflation for FY26. Our tax collections average is 13.9 lakh crores for the last 10 years. We have collected 25.1 lakh crore. Fiscal deficit in rupee terms has been 12.6 lakh crore average for the last 10 years, but I've got 11.6 this year. Fiscal deficit as a percentage of revenue, how much do I earn and how much do I spend, is one of the least, 36%. The lowest. In COVID, we were spending twice more than what we were getting as tax. Now that's come down to 2017 levels or below that, 36%. So if you look at each macroeconomic variable, which I fall in love with in terms of what are the ones which you need to check, our foreign exchange reserves are 66.3 lakh crore. Today in rupee terms, for 38.8 is the 38.8 is the average. So our foreign exchange reserves are okay from a crude price standpoint. Our crude as a percentage of GDP is reasonably okay. And 110, 105 cannot sustain for long periods. That's already seen, because it made a top at 120 already and came down below 100 as well. So doesn't worry me too much. Of course, I'm being a little more optimistic, but that's what is needed because otherwise long-term investors become short-term, looking at all these newspaper articles which said 15,000 on Nifty and 17,000 on Nifty. And that scares a person. The person who writes the article, he has nothing to lose. But an investor, even one investor sells most of his portfolio, then he's out of the market for good. So that's why I'm being a little more optimistic, so that I bring in a balance of the narratives which people throw up very easily without an implication.
Okay, got it. But we had some reports where the Israeli military spokesperson was also saying that he's been preparing for another 3 weeks of the war, and then we had the US allies rejecting the plan of opening up the Strait of Hormuz. So I mean, of course, clearly the market anxiety is still prevalent. But you also mentioned that FY26 earnings is something where you're envisaging about 3 to 4% of earnings growth. What about for FY27? Have you revised any expectations amidst all of this geopolitical conflict, or are you staying put?
See, if you look at my earning estimate for next year, FY27, Nifty is 12, Nifty large cap 100, which is what the mutual fund managers track, is 13, 15 for mid cap and 17 for small cap. On constant constituent method. What do I mean by that? Nobody on the street actually calculates this, and it amazes me. Constant constituents, by which I mean there are 4 changes which happened in Nifty. If you have to look at Nifty's growth, you have to look at current constituents' earnings growth, or on the base of the same companies which were not there. Maybe the 4, Eternal, for example, came in last year. So I can't compare the earnings without bringing back Eternal for the base. The numerator and the denominator have to be equal. So that's the method on which we calculate earnings at Anand Rathi Wealth. 12, 13, 15, and 18. respectively for Nifty 50, 100, 150, and 250, which is the last one as being the small cap index. That's the earning estimate for FY27. I think these have a high probability of being achieved.
Okay, got it, got it. Feroze, let's talk more about sector specific. Let's start with banking stocks. They saw a good amount of rally before this conflict started. And just this month, we have seen several of them declining by about 10 to 12%. Now, given that both oil companies, government finances are expected to be impacted as a result of the war, banks can see increase in working capital loans. So at this time, do you think that the fall that we are seeing in terms of the banks and even for NBFCs for that matter, is it justified or can we see further downfall ahead?
Whenever there is a rally in a certain index or a thematic index or a sector index or those respective stocks, what happens is there's a lot of frothy ownership which comes, which is short-term ownership. Short-term ownership comes with the hypothesis that I'll make money in 5 months, 6 months. If something so macro happens with respect to war, all bets are off. And these are the guys who actually sell lock, stock, barrel. So you would see the sectors which have fallen more. And then the news comes, the news has lesser impact on those sectors in spite of they being more attached to the news than the banking. Like you said, banking should actually not fall, but banking's fall is largely because there are about 20 FIIs in India, whom I have a list of, who are actually very, very short term. You would see them buy, sell it on a result, sell it in 5-7 months. Those are the guys who build positions, and that's when that index does well. So when they wrap up their positions, they actually create large damage, or at least more damage than they created at the upside. So that's what has happened to banking. I would say that's one sector, which is one thing which I liked. Auto, banking, and consumption, ABC, I would have spoken on your channel as well. Banking did very well. Auto had done very well. Consumption has so far not done its bit. I think it will do well. Banking should, from structurally, still beat Nifty from today on by 3-4%. Nifty Bank should be able to beat Nifty 3-4% compounded for the next 2 years, 3 years.
Okay, got it, got it. Feroze, you talked about auto also being one of your top picks as well. What's your status there? I mean, in terms of the correction that you have seen so far this month, Nifty Auto is also down by about 10% itself. On the back of the news flow that, there is a certain fears that the gas disruption could hit the production volumes. So what's your take? I mean, is the fall justified there? Or is this a larger correction that we have seen and this is overdone?
I look at all falls or rises in a relative basis. If Nifty has fallen 9, and if a specific sector has fallen 10, it's not even, to my mind, an underperformance worth dissecting, in my judgment. So you should not be too perturbed, because if the market did well and then there was a 10% fall, then it was basically because of the sector and what could happen to the sector because of the war. The very few sectors which in this fall have underperformed a Nifty or the broader diversified index of Nifty mid cap and small cap. So auto, I don't think it has corrected a lot yet, relatively. That's my take. So I think it continues, it will do well. And well, by which I mean not some stupendous return. 3 to 4% excess return over Nifty, compounded for 3 years, is what we call good. Because everybody have different definitions for English words like good. So that's what my definition is when I'm giving this guidance.
Okay, got it. What about IT stocks, Feroze, for you? Given the kind of correction we have seen from the last month to this month also, we are seeing that Nifty IT is down by about anywhere around 7 to 8%. There's some AI fears which is eating into the investors' concern. What's your take here? Should they stay cautious?
No, I think IT is fall is overdone, clearly. And IT, they played by the expectation as an Indian IT service provider. The IT sector has done what exactly it told you it will do. It was not positioned to be the biggest innovator in the world. And I think in the AI thingy, I personally think the last mover advantage could come to Indian IT. Because it's not very difficult to acquire if they are asset rich or their balance sheets have a lot of cash. It's not very difficult to catch up with the AI at least 10-20%, not be the world leaders in terms of AI generation, but AI is so constructive itself that you will be able to build it if you have money in your bank account. And the last mover advantage is the fact that whatever errors people are doing today, which we call the AI bubble, people are their owners are funding P&Ls. and order books, that vicious cycle which is happening in the US can burst. And if that were to happen, Indian IT will be in a good place to learn from all the mistakes and do things with other people's learnings instead of making their own mistakes.
Okay, got it. Feroze, you mentioned that this market is throwing up some buying opportunities, and you mentioned like auto is one of your top in the top picks, and apart from that, you have consumption too. Anything else, especially when it comes from the broader end of the markets, the mid cap and small caps?
Yes. So what I like to believe is if there is no opportunity in diversified categories, then I start looking for sectors. After this fall, if you just bought a small cap, mid cap index of 25% each and large cap of 100, large cap 100 or a large cap fund, you will still be able to make 14-15% for the next 3 years compounded. So you don't need to do too much bottom up sector picking also at these stages. But that will be a little adventurous also. And anyways, the market is at 23,600 or Nifty today, which I think is a good level to enter. And small caps have corrected also almost about 17% from their peaks. So to answer your question, these are the three sectors: auto, banking, and consumption. But yeah, there is a sense of equilibrium in my mind between all these three segments, which is large, mid, and small. So you can buy them and still hope and pray for a 14-15%, as long as you can weather 8-10% fall, which is what is the nature of this beast. Nifty has fallen 15% every single year from peak to trough. Every year you will have a reason, and that's the average fall. There have been years when Nifty has fallen peak to trough 30%. So just learn to live with it. Your odds of making 15% are very high if you just don't fidget with your portfolio.
Okay, got it. Feroze, just one last question before I let you go. What about the West Asia exposed stocks? If you take a look at L&T for that matter, or even Vartech, Wabag, or we have some other sectors which were crude sensitive, for instance, Spain's, and then you have OMC companies. How do they look like fundamentally to you?
Yes, I would be cautious. See, the whole West Asia or the Gulf region exposures could have different impacts. And that is something which only will unfold. It's anyone's guess. So I would be wary. I would surely be wary.
Okay, got it, Feroze. All right, with that, we have to let you go, Feroze, but thank you so much for your time and joining us.